Good morning, everyone, and welcome to the European crossover webinar. Let me turn down the volume a little bit here on the iPad. I always like to keep that one going at the same time. That way I can make sure that my screen isn't locked up or some kind of an issue. That being said, once again, welcome to the European crossover webinar. We broadcast 7 a.m. daily. For this 1 hour, covering all the majors, including the bonds, the bunds, gold. And let's go and get started. Basically, an overview. We know that we have the big event coming up, or semi-big, because it's pretty much priced in, but it's going to be the FOMC that we have coming up on Wednesday. It's kind of dictated the movement of the market overall. Let's take a look where we stand, though, right now as we come into today as far as economic reports. There we go. Now, we did have German wholesale price index, and we do have Case-Shiller this morning in the U.S. at 9 a.m. Eastern. Along with that, we're going to have Richmond Fed Services, which is a lower tier. We also had, which yesterday we had at 10:30 a.m. Eastern, the Dallas Services Manufacturing Index. The day following has the Services Index, so that'll be at 10:30 a.m. Eastern. Relatively light calendar outside of the Case-Shiller, which isn't a big mover in and of itself. We'll go on further. As we roll into the next day, it'll be the New Zealand Business Confidence. And tomorrow we have Fed policy decision. The key thing has been they've been hawkish all the way, for quite some time. And the reason I'm saying this is because even, with all the issues that was going on with the trade tariffs, I would have thought this last time they may have, maybe eased back just a bit as far as rhetoric. And that's like, that's what I was thinking was going to go and happen. They might, gently ease back, or at least maybe make a notation that things are, maybe moderating a bit, but they kept it full bore. And I guess for the most part, we might think we may see just the same thing. And that kept the euro under pressure yesterday. Although we know that when Draghi started speaking, there were some comments about normalization, and that really got the market going. We took off like a little bit of a rocket yesterday, and we'll go in and pull up the euro here. We came out of nowhere and just took off like a scalded dog, and we made it up in here. We had some resistance coming in. We actually, at the time, we had our we had already done our bias chart, and we had resistance. We talked about that key 1771, and the market had actually turned around and fell back from that area. But when we got Draghi talking, that got the market scooting, and we made that run up there. And let me take a look at something real quick. We got that run, and then we finally started going and pair back here in the euro. And my concern at the time was a couple of things. When Draghi starts talking, one of the things over the last few years, anytime the ECB mentions anything about even getting the slightest bit, forget hawkish, just maybe not as dovish, the market goes nutso. And one of the things I didn't want to do is I just simply didn't want to be in the way of Draghi. I was able to go and sell some on the way up, and sell some right at the top essentially. But I ended up covering, and some of the guys in the room hung on a little bit longer. I think Blake may have he also sold some, but I ended up getting out, and then only to see the euro continue to go in and slide back. Now this morning we got another pop back up, and you're thinking, where the heck is this coming from now? And I saw Peter Pratt on the wires, and we'll go in and cover that story. He was talking about normalization, and that's what I'm saying is every time you get even a little bit of a inkling of any kind of a change, they just go gangbusters, you know. So same thing we saw the euro pop up. Now going into the FOMC, chances are the rhetoric's going to still stay, you know, hawkish. I think the only difference is with the dollar index, I think it would take some very hawkish data, hawkish rhetoric, let me put it that way, to get us above this 95.50. That would actually turn everything around. I just don't necessarily see that, but we'll see. But, you know, it's interesting to note that even though the FOMC is tomorrow, pretty much everybody expects what's going to go and happen. We're not seeing the, you know, you would think that the dollar index, you know, here we are at 94.17. I would think that going into the FOMC, you'd probably be somewhere up in here with the thought, okay, well, they're already bullish. How much, you know, how much more hawkish are they going to be? So we're still hanging around these lows. So my thinking would be that although I think the rhetoric would be hawkish, I think it would have to be ultra hawkish for us to really get going. So to me, I'm still going to respect this pattern that we came with, and it's bearish. So I still want to be a seller of any rallies in here. And going back to this on the 2 hour on the euro, to me, anytime you talk, you know, like here was the euro, it was just, you know, sucking wind at the time, sliding back. All of a sudden, Draghi just mentions a couple of comments of normalization and shoots up, takes off like a scalded dog. Okay, the only thing that kept this euro from not going higher was because we had the FOMC. Now we start sliding back. Okay, well, you know, we have the FOMC, nothing's going to happen. Peter Pratt comes on the wires and here we go. Some more talk about normalization, and we get one of these, you know, rallies again back in the euro. So to me, it just, I think that going forward, then the talk will probably be, well, you know, the ECB is now starting to turn around, and not that I think they are going to, but I tell you what, if the ECB was turning around in the year 2025, they'd still be saying, you know, they're getting ready to turn around. So this market just seems like it wants to rally. It's being held back because of the FOMC, and at least that's my take. And I think it would take an extremely hawkish FOMC in order for this dollar to go in and reassert itself at this point. I don't think the dollar is going to heck in a handbasket, but I still think that there's a good chance we're going to come down here in this 92.80-ish area here eventually. So I think any rallies, but like I said, let the rhetoric come out, let them see what they say, and then we'll see where the market is. But it's still woefully weak if you look at it. I mean, we're just a day away from the FOMC, and we're still hanging not that far away from the lows, which just seems rather odd considering how hawkish the FOMC, all the hikes they've already had, how hawkish they've been. There's still a couple more baked in the cake, and that might be the case because it's baked in the cake. The economic figures are still pretty good, very good, and yet still look, we're languishing near these lows. And that's why I believe that any rallies back will probably be an opportunity to go in and fade here on the dollar index. So let's go and take an overview of what we saw last evening as far as get us up to speed on what's going on before we jump into the bias chart. We saw the dollar CAD pick up just a little bit, not a whole lot, but a little bit. And it says here the dollar CAD slips as U.S.-China trade spat dims the global growth prospects. Every day it seems like it vacillates one way or the other. Either the market's not worried about it or it's about to start worrying about it again. So it says the Canadian dollar weakened against its U.S. counterpart. You can pin some of the weakness on the deteriorating situation between China and the U.S., says Ben Pare, North American head FX strategist at CIBC. The United States and China imposed fresh tariffs on each other's goods as the world's biggest economy showed no signs of backing down from an increasingly bitter trade dispute. The price of oil, one of Canada's major exports, climbed after Saudi Arabia and Russia ruled out any immediate increase in production dispute, despite calls by President Trump. You know, if anything, you would have thought they would have done just the opposite, and that's exactly what happened. I mean, and I'm just talking about reality, I'm not talking politics, with the way he's gone on with the rest of the globe, and I know he was saying they need to bring it down now. Well, they were definitely going to go on and not respond to anything he said. And if anything, do the opposite. And that's why prices are even higher now. And you see that run up here in crude oil. So that's not a surprise whatsoever. Still, speculators have raised bearish bets on the Canadian dollar for the third straight week, data from the CFT states. So let's go and move on. And the Australian New Zealand dollars ease. Fed offers a distraction from trade. The Australian New Zealand dollars edged lower on Tuesday as investors look past the Sino-U.S. trade dispute to ponder what surprises the Federal Reserve might spring at its coming policy meeting. The Fed path points to reaching neutral, 2.5% to 3% by mid-2019, said Gavin Friend, senior market strategist NAB. He noted U.S. Treasuries had already priced in a more hawkish outcome with short-term yields at decades highs. And boy, can you believe this? Look at these bonds. They are really, and we talked about this is still a key area. So we're just below a point, but this is still a very key area here. But look at the bonds on their lows. Look at this. We talked about this last week. Dude, where's my bond rally from the 90s movie? Dude, where's my car? Dude, where's my dollar rally? I mean, look at the dollar. It's not that far from the lows. And we've got U.S. yields just going higher and higher and higher. Hence why I think that the dollar is more of a fade after the FOMC decision. Most would expect hawkish rhetoric, but I think we'd have to be ultra hawkish in order for the dollar to do anything. So my take would be any rallies on here would be a fade. We would, just going with technicals. To me, I wouldn't believe this dollar rally until it got above 95.50 on a daily close. And you're talking about 140 pips at this point, or 115 pips, ticks that is. That suggestion, there was a chance of yields would retreat if the Fed sounded less than hawkish, offering an excuse to sell U.S. dollars. The dollar has weakened despite higher yields and strong growth metrics, which may suggest a shift in foreign investor appetites, added Friend. We've been talking about that for the last week. Germany's 10-year bond also climbed to its high since mid-June after the ECB Mario Draghi highlighted a relatively vigorous pickup in inflation and noted building wage pressures. Once again, that's suggestive of, maybe they may start to wind down. Maybe there's a little bit more momentum rolling that way. And that's what I'm saying is it doesn't take, if there's even a whisper of that, you see this, if there's even a whisper, you see the euro take off like crazy. You see, so it wants to rally. This morning, here we are sucking wind at 17:30. Peter Pratt goes on the wires. He's talking about normalization, and the market just goes and shoots up, despite being right there in the face of the FOMC tomorrow. So that's what I'm saying. This market wants to rally, and dollars seem like they can't rally no matter how high U.S. rates go. We thought the New Zealand dollar would be a little bit more positive momentum here as trade faded into the background, at least for now, but the failure to break above 67 cents suggests the path higher is going to meet some decent resistance. So let's go and move on so we can quickly get on to the bias chart. The euro struggles despite Draghi's inflation comments. The euro struggled on Tuesday despite the ECB President Mario Draghi's comments about relatively vigorous inflation in the previous session, while the dollar paused before the U.S. Federal Reserve policy meeting. Analysts had largely interpreted Draghi's speech as hawkish. Eurozone money markets brought forward their expectations for a 10 basis point ECB rate hike. Here's the U.S. Hike after hike after hike after hike after hike, and look, just the hint, just the hint of a 10 basis point, not even a quarter point hike, is enough to send the euro from yesterday just screaming higher. And the only reason it didn't scream much higher is because we have FOMC. But it just tells you that this, I think it would have to take an incredibly hawkish FOMC to get this dollar to rally back and hold that rally. There's a general lack of impulses. The market's not reacting to the trade war because we're not seeing any economic impact. The other big driver is usually monetary policy, but the FOMC is going to be a non-event, said Landwin, currency strategist at Commerce Bank. The dollar remains the absolute go-to currency when there's any question about risk or stability or these geopolitical situations, said Bart Wakabayashi, Tokyo branch manager. The minutes showed a few of the Bank of Japan's board members said the central bank must consider more seriously the potential dangers of the ultra-easy policy, such as a negative impact on the country's banking system. That being said, the dollar yen is holding its own up here. We had a resistance at 1284, but it's still hanging there, and we'll move on. Let's go on and get with the ECB, and this is what we're talking about this morning. So if you're looking at it and thinking, wow, what the heck happened? Euro was right here at the lows, and we got a little bit of a good little rally here. Well, once again, if any ECB member even whispers about normalization or whispers about inflation, the euro gets its big-time rally boots going on. So it says the ECB is not planning to speed up normalization. The Eurozone economy remains on course for the ECB to cut stimulus by one more step at the end of the year, but normalization will not be any quicker than projected in June, ECB chief economist Peter Pratt said on Tuesday. Playing down the market speculation that a recent comment by Draghi foreshadowed quicker normalization, there's nothing new, Pratt told a conference referring to Draghi's speech. Clearly, we see progress in underlying prices. What is behind the inflationary process? But it's a long process and conditioned on very easy monetary conditions. But Pratt dismissed the idea that there was a message in the choice of words and argued that the market reaction was unwarranted. He even argued that recent market pricing, which put the bank's rate increase for some time in the fourth quarter of 2019, were broadly in line with the ECB's governing council's own scenario. The ECB expects its 2.6 trillion euro bond purchase scheme to end at the close of the year. It expects interest rates to remain steady at record lows through the summer of 2019. Comments also appear to reject the recent argument by Austrian Central Bank Ewald Novotny that the ECB would speed up any policy tightening. Pratt said that the biggest risk to the outlook is a growth accident or an unexpected drop in the bloc's expansion, which could dampen the inflation outlook. And lastly, with gold. Gold steady as investors await the U.S. Fed move. Gold is glued to the $1,200 seesaw levels with some short positions closing in just in case the Fed does something unexpected. A dovish inference could send gold prices above the 1210 area. There's a lot of cross interference for this week's forward guidance from the Fed meeting. Gold has fallen more than 12% since hitting a peak in April. China and the U.S. imposed new round of tariffs. If the lingering trade wars, fears of renewed emerging market jitters, sour sentiment, a U.S. dollar may reclaim a haven bid, making gold vulnerable. Gold is making a strong base between 1195 and 1205. Doesn't look like we'll break the support range, said Vandana Bharti with commodity researchers SMC. The Fed will meet, will limit upside or stimulate some correction in the first half of the week. In the second half, we can see some level buying in gold across the board, and silver should match in step. So let's go and move this out of the way. And let's go and move into the bias chart. So we had 1771 as our resistance. This is right where the market started turning back. I think we got up to maybe 74 or 5, and then we, started sliding back. And I got into what was in the mid 40s or so, lower 40s, before Draghi started talking about the vigorous inflation or slightly vigorous inflation, and the market just went bananas there for a while before sliding back. And like I said, Peter Pratt had some comments. We saw the story there, and the market turned around and took off again. So let's go and take a look at what we are with the euro. It may be a relatively quiet session ahead of FOMC. The key thing here, one of the things that we talked about was whether or not the market was going to be able to get above 1771 right here. And we did get that close, and then we started to slide back. And right now, I think we're just going to be treading water until we get past the FOMC. But my take, like I said, I think it's going to take a very hawkish FOMC. And not that I don't think the rhetoric will be hawkish, but it's going to take a very hawkish FOMC to get the dollar back on the bid and send the euro much lower. So for right now, the support's going to be the 1707. I don't see anything changing. In a break here, I think we'll find buyers there at 1707, so nothing changes there. And then resistance on a very short-term basis is going to be right here, 1794. That's what it would take to get this market chugging back to the upside, 1794. We did run out of gas yesterday. We're talking in the chat room, which was right there at that 1815 area. And so right here, right there, 1815. And I think like I told you, when I redid some maintenance work on my computer, for whatever reason, a lot of these lines, my levels didn't even save, and that was frustrating because I found myself doing a lot of work all over again. But it was 1815 that we talked about in the chat room. I think it made right to that price of 15.5, maybe 16 for start to slide back. But we're looking at these touches coming across the board. But here's where the market could potentially get to. Is up here at 1838. And we'll pull this further back. The reason I'm looking at that 1838 is once we get past the FOMC, if we do see a rally, this is where I think they'll make it to. And actually, as I told you, some of the work I didn't get saved, but there's also 161% things from here to here that comes in like around 1860 or so. We'll just do a quick fib. Once again, like I mentioned, when I did that maintenance, it didn't save any of my charts, and that was really frustrating. So I'm having to do a lot of my work all over again. But you can see here, there's 161% of this recent move here. Now, so let's go in and go with 1794. Once again, if we get a bullish or hawkish FOMC, that would not be a surprise. That's what we would already expect. But a break in here is probably going to take us as low. We may take out 17, maybe. Probably right in here is going to be real good value buying all the way down to 1690-ish, right there. But once again, like I said, I think the market already has that priced in. I thought last FOMC we might have seen the group, ratchet down a little bit of the rhetoric, but they were still on, still going full bore ahead. And so I really don't see anything, although, we're coming along. You would think they may take a pause, but we'll see how that plays out. But I think this euro just wants to move higher. You can feel it. I mean, it just doesn't want to come down. It'll slide down. We certainly slid down yesterday, and I didn't want to stand in the way of Draghi. If he started talking, once again, I think overall, you see here, we're starting to continue to move higher. I think this market still, you can see it, you can feel how each pullback reminds me, it's not the same thing, how the cable's been. Each pullback, they buy them and set them up higher. Each one, well, this one, it's not quite the same thing, but each pullback, you can essentially say they consolidate and then they start to push back higher. So this market looks like barring a super hawkish Fed, it looks like it wants to rally once we get past FOMC, but we'll see. So let's get enough of that. Let's go on and move into the cable. Same thing here. A lot of the lines that I had got all messed up. So where is resistance coming in? Yesterday we had Yesterday we had 31.62, and I think the market made it up to 31.68. There we go. And resistance. We'll just move just up a little bit higher, 31.68, but I would be a little bit concerned. We'll just see. I mean, this is where they ran out of gas, and this was our level, but we had 31.62 yesterday. You know, even with this pullback here, this market holds up very, very well. We'll go right here with just the technicals. That's going to be 31.68. Nothing's really changed here on the cable. Still looking very good, even though it looked pretty woeful on Friday. And you would have thought maybe they might have even, although we know this 3056, that's what we have in crimson. It's our pivot, our bias pivot, and we know how key that 3056 has been all along. But it didn't even try and take that out coming into the Sunday session. And we saw strength yesterday, a bit of a fade, and here we are back up here challenging support. Then, and we had, I don't see actually any reason to change that. We had our support, remember yesterday, 30.87, and the market dipped as low as 30.95. So about what, 8 pips above our support that found that. So we're going to stick with that 30.87 here. I think the market may be treading water until we get past this FOMC. Let's go and move in now to the Aussie dollar. The Aussie dollar's held up relatively well, but it's been very, very quiet. I mean, you would think this is a 15-minute chart, and it's actually a 2-hour chart, and we just gently paired back in very, very tight ranges. Look at this. This is just unbelievable how this is a 2-hour bar. And look at this. Some of these are maybe, what, 8 or 10 pips for the entire range of a 2-hour bar on this one right here. If the dollar, we do see this dollar slide back, this is where we're going to go to. The 73.20, we have that already marked off here, 73.20. And we had our resistance, or our support, I should say, at 72.19. And we'll allow for that. So I think the 72.19, any pullbacks here are going to be supported. I think there'll be an opportunity for anyone that's short the market to come in and look to go in and cover towards the 72.20. So I don't see any changes here with the odd at all. As I mentioned, I think we'll be treading water until FOMC. We may see a little bit of movement here in the euro and cable, but for the odd, probably relatively quiet. We just see, look at the euro just now, just jumped up to 17.85. And that's what I'm talking about. We'll jump into that real quick. You see here, we're popping up even higher. And look at the dollar. Here we are after the Fed hikes and hikes and hikes and hikes. And look, we're over here hugging near the lows. And that's what I'm saying is it just, you can feel it. The euro just wants to move higher. And look at this. Moving into the Kiwi. Starting to gently slide back, and same thing here. I don't see any changes. We have 66.14 for our support here for the Kiwi. I don't see anything really, and then here comes a 14 right in here. So coming in right there for support. Market just basically treading water. We came right here to this level at the 66.36. You can see the market just kind of hanging around that support. But we're going to stay with the same thing. We had 67.05, 66.14. I don't see any changes here for the Kiwi. I do expect to see some good movement once we get past FOMC. And with that, we'll move into the dollar CAD. Now with the FOMC, I think we can punch up a little bit higher. And this is, I think, we're looking right there for our resistance, 30.15 that we had from yesterday. Same thing here. I don't see any real reason to go on and change that. So if we get a the FOMC plays to the same tune of being relatively hawkish, that'll probably allow the dollar CAD to move up here. But I think this will probably be viewed as a nice selling opportunity all the way up here to 30.40. So tomorrow we may push our resistance a little bit higher. But for right now, it's just going to be this 30.15. No changes from yesterday. You can see here the market has been trading relatively quiet. And support we had here at 29.15 and coming in right there. Same thing, no changes. I don't see anything to change here on the dollar CAD either, just the same as it was for the Aussie and the Kiwi. The only thing I will note here in the dollar Swiss is that we do have nice little hammer, mini hammer bottom right here. And we've seen some follow through on that. Let's go and take a look where we stand here on the 2-hour chart. And as I mentioned, this is frustrating because the work I did was not saved. So basically starting all over again. And so now that's why you're seeing all these lines all over the place. Despite the work I had for the week, it's all gone. So let's see where we stand here in the fib. We seem to be stalling just a little bit here at this 23%, and we had the 96.53. I believe that was our resistance here. Let's take a look. Actually, 96.27. So we've had a nice run up here in the dollar Swiss. Yeah, we had 27 there. Look, we've had a pretty good little run up here. I would like this 53 level. When we look as far as resistance for the day, and the market is very oversold, we'll go on and give it right here, just above there. See it right there? 96.76. Market trying to put in a short-term bottom here. We even had a nice little mini hammer even here, right here on the 2-hour. Not to mention the same mini hammer that we had here on the daily chart. After the fall that we've seen here in the dollar Swiss, and the most recent fall really came with a bit of force here. So I think the market is overdone. I think they'll use those opportunities going in and buy this market back. We'll have to see how we react after FOMC, but at least for now, support's going to be right there, 96.13. 96.13 here on the dollar Swiss. Now let's go and move on now to the dollar yen. We're gently pairing back from that 1284 that we had yesterday, but this market is really hung tight up in here. You know, you see, when you take a look where U.S. rates are right now, this dollar yen should be closer to 114, if not trying to make a trek towards 115. I mean, look how low these bond futures have gone, and U.S. rates have shot up. And although the dollar yen's hanging around here, to me, it seems like I don't even get it. How can you not be higher here? So if you look, this is in July. Okay, so July. So let's take a look at the bond futures and where they were in July. So we were trading at 143. So we're 4 full points lower. Yet the dollar yen's even lower than it was in July. And the bond futures are 4 full points lower. You would think that this would be, you know, like I said, probably really about right around maybe 14, 17. So, I don't mean 14, I meant 1370, like 1370 up in here at the very least, if not just above 114. So we'll see what happens, but I mean, once again, it doesn't appear to be making the most of its rally. This one might be rather susceptible if we do see a dollar pair back, especially if bonds start to go on and move. This is one to go on and keep an eye on. Certainly not a short at this time at all, but one to keep an eye on once we get past FOMC and you see the dollar reaction and you see bond futures reaction. The bond futures are pricing in everything but the kitchen sink on this move. And we know that this 40-20-ish area here is very key level going all the way back to 2009. So but when you look at something going back for multiple years, if you overshoot it by a point, that's probably within reason. What I'm saying is if we get a rally or if the Fed doesn't appear, these bonds could go screaming right back. And it wouldn't even change the complexion of anything. You could easily scream back probably 2.5 points, easily, if not maybe 3. But it's something going to keep an eye on because, like I mentioned, they've priced in everything but the kitchen sink in these bond futures. So where we are with the dollar yen, well, the dollar yen is still bullish. I'm still going to stay with this 1284 right there. It did get above it, but we've now slid back below it. And I'm going to stay with that 1284 for resistance here on the dollar yen. Now, as far as support, right there. For right now, on a short-term basis, 1242. It'll be much lower going into FOMC, but we'll go with 1242 for today. Probably revert it back to this 1211 tomorrow. So let's go into the cash dollar index. We had a resistance at 94.68. It hasn't even come that close to 68. And hence, look at the euro, still pushing higher here. Look at that, 1788, not too far away from our 94. That's what I'm talking about. You've got this Fed, hawkish as all get out. Nothing's changed. As I mentioned, last Fed meeting, I thought they were going to maybe ease back a little bit on the accelerator, and they kept it trumped all the way down. So with everything going, everybody expects a hawkish Fed, and still the dollar can't pick itself up. There's something woefully wrong with this dollar. And it has the benefit of higher rates. Still no effect. Trump and China going back and forth with the trade tariffs. Still no effect. So, as I mentioned, to me, I think it's a fade on any rally going to the FOMC. That may not seem like that's saying a lot now, but I'm saying is that's how I see it. To me, I would not be bullish on the dollar unless it closed on a daily close above 95.52. That's what it would take for me to be bullish the dollar. And that's not even an opinion. That's just the technicals right there. This market would have to claim 95.52 on a daily close in order to turn this thing bullish. It's not bullish. That's not a bullish trend. You can look way back and say it's bullish, but this is not a bullish market. And it's not even responding bullishly to fundamentals such as higher U.S. rates, which you can see here. Not responding at all whatsoever. Not responding to the tariff news. No response there. And not responding to a rather hawkish Fed with a meeting tomorrow with an expected, although priced-in rate hike, but the rhetoric's been nothing short of hawkish all along, and still it can't pick itself up. So this is our resistance. For today, I'll keep this here, but at this point, it certainly looks like this market would even have a tough time even getting beyond 41. You see right here? Actually, we're going to move it down there, so we'll call it 94.41. This is at next level, but it just keeps on moving lower. So any moves to 94.41 for today. We'll see where we move things tomorrow. The euro just got up to 17.90 and it slid back 6 pips. Remember, our resistance is 17.94. Support here on the cash dollar index. We talked about this yesterday. That's our area. If we break lower, we tried to hold. I think that's the next area for them to go to, but I don't see them going to 93.46 today. The only thing I think we can go with is that same intermediate level we had before, which was 93.72. So we'll tighten it up a bit. Seems odd to think about the dollar going lower, going right into the teeth of the FOMC. And we'll move into the gold market. Now, we had a resistance here at 12.11 yesterday. We see the market ran out of gas at 12.09 or 12.08.90. And someone was asking about this yesterday. They said, whoa, look at gold. And I said, hey, look, nothing's going to change on gold. And that I was telling them, I go, that's why I put because I said, look, there's that area here, that 12.08, but that's why I put the resistance at 12.11, because you can make it all the way. We talked about this yesterday, remember? We were down here at, what was it, 03? And I said, you can come here to 12.08 and it doesn't change anything with gold, because we can quickly, we talked about how it's been up and down. We can slide right back down. And that's exactly what happened here. So I said it would take a close at 12.11, and we even showed it. There's our 12.11 right there. You see there, the touches? I would take right there. You see that? And I said it would take that because that way it would be able to reclaim this trend line. And you see here how we came up here at 12.08 and we quickly just went right below that trend line again. So I said, if we got a 2-hour close above 12.11 right here, that would reclaim this trend line, and there'd be enough distance to say, wow, it's back in play now. But that's what's arguing, is that a move to 1208 didn't change anything. It was still going to keep its relatively weak structure. And that's what it's doing right now. This has been invalidated in my eyes. The reason I want to keep it there is just to reinforce that it's really having a tough time. Because one of the things that we talked about, or I did on the analysis for ForexAnalytix, which was Sunday coming into this week, I said, hey, it's going to be with and we mentioned that yesterday, a defensive tone, meaning, rallies are going to be questioned. Okay. And so this just reinforces that. We've broken it. We got above it, and here we are struggling again with that. And we're just hanging around here only because the dollar's lower at this point. So resistance is still going to be the same, 1211. Support, nothing changes. It's going to be this horizontal level, 1197. So we may be treading water. The only thing that, and it mentioned in the same thing in the story, was that if we get a surprise out of the Fed, let's say they ease back a little bit off the accelerator, that could get gold, moving. But it's mired in this range that we talked about, just going back and forth, back and forth. And that's one of the things we talked about yesterday, and why our resistance was up there at 1211, because it would take a 2-hour close above 1211 to really reclaim this trend line and try to get things on the positive. We did make it up to 0890, basically 1209, not at the 1211, and here we went and started to slide right back down again. So it's going to be 1197, 1211. That's going to stay the same, and now we go to the bonds. These bonds are just continue to stay in a world of hurt, no matter how low you put the support. When we looked at that, it stays just as weak. The only thing we look at is just put it to today's lows right here. And it's pricing in, as I mentioned, it's pricing in everything but the kitchen sink ahead of the FOMC. The only thing you can see right here is right there on the day's low. It's going to be 39.17. It seems odd that, like I said, the bonds continue to move lower, obviously have an inverse relationship, so higher in yields, yet no matter how much the bonds move lower, it provides no real support for the dollar. The dollar just can't get any oomph off of these higher yields. Now, as far as resistance here in the bonds, it's just honestly just plain technicals right now until we get past FOMC. And right there, 140 even, 140 even. And we're well ahead of time for right now. But we've got the bunds here. They continue to languish near their lows themselves. And right there, 57.87. And this market has really changed from bearish to bullish to bearish to bullish to bearish to bullish to bearish, back to bearish. This market changes rather quickly. but it's going to be 57.87 at this point. Resistance would be right there at 58.08, 58.08 here on the buns. The most recent high right now just came back in at 58.03, so it'll be 58.08. Well, we had 12.396 and 12.312 as our support. The market came down to 12.305, and we had 12.312. And we had 396, and we just came up to 12.404. Let's go and move this now to a 30-minute. Now this is a long-legged doji, which would suggest a pair back here. Market, a long-legged doji, bears don't have control, bulls don't have control. You finish in the middle, and usually you see a pullback from what the most recent run was. Well, the most recent run obviously is up to the upside, so we would expect a likely pullback. That pullback comes in right here. For starters, be 12.350, but we'll move the support a little bit lower. Right here, 12, right there, 12.341, 12.341. That's a very, very, very tight support here. Let's take a look at this, the run that we've already had. And if you're scalping it, 12.341, but we came back right, look at that, to the 23%. And we had our resistance, supported 12.312 yesterday. We're actually going to move it right here. Initially, you got 12.341, but we'll put here to 12.326. For today's bias chart support. Right there for support resistance. It's going to be 12.412, 12.412. I think we'll be in a relatively tight range till we get past FOMC. So it'll be 12.412. So there's the bias chart support levels for today. We finished early, and we'll take a quick overview here. The euro continues to hold up very, very well. As I mentioned, we were under some pressure coming from Friday as the cable ran to some bit of a downdraft, which I thought the euro was prepared to even go higher on Friday. But when the cable came into that extreme pressure, that weighed on the euro, kept on the defensive as we came into Monday and looked like we were trying to work lower. And then Draghi got to talking, mentioned about the inflation, and man, the euro shot up like a rocket. We began to go on fade fade from here and continue to go and fade back. And here comes Peter Pratt, and he starts talking, and the euro takes off again. So to me, it just feels like this market really wants to go higher once we get past this FOMC. Doesn't feel like there's anything that's going to hold it back. The only thing I see holding it back is if the FOMC goes from hawkish to extreme maniacally imposed hawkishness. That's the only thing that I can see that's going to push this dollar higher at this point. It doesn't want to respond to anything at this point. So that's about the only thing. If I thought there was even a chance we might even have pushed even a little bit higher yesterday, although I shorted it, I actually covered well before it even moved a whole lot lower, because I've been in the way of when Draghi speaks, and I've been run over before, and I wasn't interested in getting run over. But we continue to move lower, and like I said, now Peter Pratt got on the wires this morning. That sent the euro right back up again. So to me, it looks like this market is going to be well supported on any pullbacks. And the thought being, you know what, it's a little bit, like I said, the Fed keeps on raising and raising and raising, and here's the ECB talking about maybe even the thoughts, a 10 basis point hike in the third quarter of 2019. It's enough to send the euro running like crazy. So, like I said, you kind of look at the things that don't seem to make sense, but you got to go with how the market plays it. Going here at the cable holding up very well, which it has been doing even after Friday. I thought we might have even seen a little bit more downside action where they may have tested this in the Sunday session, but the market held up. I mean, this 3056 is where they went to. We talked about this in the chat room, and that's where they went to, that 3056 eventually. They were hanging around the 3080, 3070, and finally they made it down to 3056, and that held. But here we are trying to push higher again. We have our resistance here. We actually marked that off as 3168, but this market sure acts like it wants to try and move higher, but we are at a key level here at the 3168. Going back to the dollar index, to me it's just bearish. I think unless we get a crazy hawkish Fed, I don't see where this market can turn around at this point. Just going with the technicals, we needed, at least in my eyes, you need a daily close. You need to close above 95.52 in order for this market to get back to bullish, a bullish bent. Anything other than that, if you're looking just straight up technicals, you can't argue that this thing is not a sell on as a fade on any rallies back. It has not done anything to prove itself at this point. Gold just being moving back and forth in this range. I shared that basically moving in a this range capsulated, if you want to call it, up on the upper band of 1216. But you can see it's just up and down, up and down, up and down, up and down. And it would take a 2-hour close above 1211, which we didn't get yesterday, to go and grab a little bit more of the bullish momentum. Right now, it's a defensive posture. And the dollar CAD trading relatively quiet here. Not a whole lot of action. Seeing the same thing here with the Aussie. Here's the Kiwi. Next target up here for the Aussie dollar is going to be the 73.20. And we may see this dollar start to garner a little bit more momentum to the downside once we get past FOMC. As I mentioned here with the 30-year bonds, pricing and everything but the kitchen sink, but it has not been beneficial for the dollar. And the dollar yen, we're keeping our 1284, still bullish, but it sure seems like it should be a heck of a lot more bullish in light of where U.S. rates are. So you have to wonder what's going to happen if we see these U.S. rates pop back and the dollar starts to slide. With that, we should have Dale up. And thanks for joining us here on the European Crossover webinar.
Great analysis, Paulie.
Oh, thanks. Thank you much, Dale.
I listen to you, and you bring up areas that that I agree with. So that makes you great. Actually, it gives me more conviction about the importance of those inflection points that you're bringing them up. In fact, before you leave, I just have one laugh for you, okay? Before you go, let me just share my screen here. And it's one of those, I've heard a lot of ridiculous commentary on CNBC over the decades, but this has got to be the most. Let's see. Which one's me? Which Dale Pinkert? I'd say this one's me. Oh, it keeps moving around. Anyway, let me try this. I'll make myself presenter. Okay. So, the market was down yesterday, Paulie, because of everyone worried about tariffs, except NASDAQ, which had been the relative weakness. And I heard a commentator on CNBC say that people were buying FANG stocks as a flight to safety. What do you think, huh? I mean, have you ever, a flight to safety, obviously this anchor was not around when things like T-bills and TED spreads and bonds and gold were kind of flight to safety. Now it just shows you how, that people can't be out of stocks, that they'll rotate from one sector to another. But yesterday, the flight to quality were FANG stocks. So, I can't argue with them. They had a great day, and but I can say this: if we take out yesterday's low in NASDAQ 100, there's a lot of vulnerability in the air underneath. So I thought you'd get a kick out of that because I know every time. Yeah, go ahead.
I was gonna say these equities have held up like a champ. I mean, we're actually going towards the end of September. Sometimes we start to see the weakness, come in. We had a very good August come into September, and these equities are just holding up. Yeah. So
it's fought every seasonal, huh, buddy? But
yeah, you would think seasonally you'd probably see a bit of a pare back, but yeah, it's still holding up like a champ.
And I just thought that you would be able to relate, because I know you and I, every time we're worried about risk, we'll buy, I don't know, Netflix or Amazon or, Facebook, just to make sure that, if there's anything systemic out there, we're in something safe like Facebook.
Mm-hmm.
Right,
buddy?
I don't
do too much. Yeah, I will say I don't do too much with equities at all, but I see the take on that. But to me, the thing and it hasn't phased the market is these rates. I got to give the market. I got to give equities props that they have just looked the other way despite rising rates. When you look at the 30-year bond or 10-year futures, it's just they're just completely oblivious to what's happening in the rates market, and that's just reality. How we see it. Although I think there's a problem with the dollar. I mean, the dollar has everything going for it, and it still can't rally, up any higher, with tomorrow being FOMC. So to me, the dollar's a fade on any kind of rally. Matter of fact, I'm upset with myself for not picking. I saw the euro near those lows late in the Asian session, and I thought about picking up. And I'd say, well, might as well just wait till I get past FOMC. But just goes to show you, this dollar's not going to rally. It's just not going to. To me, barring a close above 95.52 on the dollar, to me, it's a sell on any type of rally.
Maybe it happens. In fact, I was going to start off with that. People that follow my work know I look for 3 drive formations, and yesterday this spike candle that we had on the hourly did not confirm. and gave it up pretty quick. So I'm thinking if we get a third drive, actually after the Fed, and I guess the key statement for the Fed tomorrow is whether or not they keep the word accommodative in or not. So it's not what they're going to do, it's what they say, and everyone's focused on that one word. So I hope they accommodate you and everyone else in our community to get the trades off they want to get off. So thanks a lot, Paulie.
Well, you have a great day.
It's a great way for me to get started. Used to come in cold, and now I could listen to you and kind of get a feel for what's going on before I take over the microphone. So good hunting to you today, buddy.
You too. Have a good one.